Why the US is doomed for an economic collapse. The post pandemic celebration of the US economy is finished. Set your seatbelts for a brutal come down. A combination of emergency lending programs, record low interest rates, and almost $5 trillion in government stimulus enabled the US economy rebound at one of the fastest rates in modern history. But there was a cost to that quick recovery. The cost of secondhand cars was the first driver of innovation in the spring of 2021, but it soon spread to gas, food, and housing expenses. 1. Americans are burning through savings. Households don't have as much money as they did a year ago. As expenditures fell, and households received stimulus during the early stages of the pandemic, America's amassed a $2.1 trillion saving cushion. However, they have already used $630 billion, or about one-third of that safety net. While the cushion is currently far higher than the pre-crisis level, it is quickly evaporating. Americans have to choose between reducing their spending on necessities and using savings they had before the pandemic, because the rate of decline has intensified recently and inflation is still biting households' budgets. Their daily cash flow has likewise decreased. After taxes and inflation, the average American's real disposable personal income per person remained unchanged at $45,300 in August. 2. The historically strong job market is likely nearing its end. Another benefit to Americans during the recovery was the extremely tight labor market, but that trend has also changed due to rising interest rates and worries about a short-term recession. American businesses are reducing their hiring intentions. Although September's job growth was still historically significant, it continued a long-term trend of progressively decreasing growth. In contrast, August saw the biggest decline in job lists since the pandemic's early months. Worker wage declines when employers' demand for labor does. Monthly pay increases now resemble the pre-crisis average after slowing from the fast rate witnessed earlier this year. The median worker's weekly wage is less than it was prior to the early 2020 lockdowns, even after accounting for inflation. 3. More economic damage will result from the Fed's battle on inflation. As the Fed has intensified its war against inflation, the historically low rates that helped households through the crisis are also non-existent. The benchmark interest rate set by the Fed is currently between 3% to 3.25%, much above the point at which rates tend to stifle rather than stimulate economic growth. The average credit card rate is already 2% points higher than it was in March, and it has assisted in driving mortgage rates to highs not seen since the mid-2000s housing bubble. The central bank continues to portray rate increases as its strongest tool for containing the price increase. But until headline inflation returns to normal, Americans will continue to face higher costs and more expensive borrowing. Therefore, it makes sense that experts are almost convinced that a recession will occur within the next 12 months. Bloomberg economists predict that the likelihood of a downturn by October 2023 is 100%. 4. In the event of the next recession, Congress is unlikely to come to the rescue. Americans should not expect much assistance when the next recession hits. Inflation remains at 8.2% year on year, making lawmakers extremely hesitant to inject more money into the economy. Republicans are also poised to take control of the House following the November midterm elections, further reducing the likelihood of a bipartisan stimulus bill if a downturn occurs. The Fed has promised to keep raising rates until the job is done, virtually guaranteed that borrowing costs will rise and the economy will slow even more. Bringing inflation under control is critical to launching a healthy economic expansion. Until then, the next recession will be exacerbated by the recovery from the previous downturn. Simply put, the typical household has already reached its financial ceiling. Americans are saving less and relying more on their emergency funds to get by. Weaker saving can make the probable upcoming recession worse once the cushion runs out.